You're listening to the Sage Planning Solutions Podcast. Securities and advisory services offered through Catteray Grant & Company Incorporated, a registered investment advisor and member FINRA SIPC. Catteray Grant and Sage Planning Solutions are separate and unaffiliated entities. The information provided here is for general informational purposes only and should not be considered an individualized recommendation or personalized investment advice. Any opinions or forecasts contained herein reflect the subjective judgments and assumptions of the authors only and do not necessarily reflect the views of Catteray Grant & Company Incorporated. Investing is subject to risks including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. This information is not intended to be a substitute for specific individualized tax, legal, or investment planning advice. Neither Catteray Grant & Company Incorporated nor its registered representatives or employees provide tax or legal services. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice.
Welcome to the Sage Planning Solutions Podcast. I'm your host, Dominic Ruiz, and I'm joined today by my two co-hosts, Patrick Bennett and Brad Marshall. In our previous episode, we discussed the preservation phase, and today we'll be discussing the distribution phase, which is the last phase of a three-part series. So please join us as we dive into the complexities of the distribution phase. So gentlemen, we finally reached the distribution phase, aka the spend stage. By now, investors should have had enough assets accumulated to last them for the remaining part of their financial life. So let's get right into this, gentlemen. What are your thoughts on the distribution phase?
You know, this is tricky because the hardest thing for people to wrap their minds around is not having that check monthly for income. And so one of the things that we do, and again, I've said it a dozen times, that I don't love the buzzword financial plan, but here is a critical part of your plan, which is the cash flow. So even if you don't have a big, tricky, comprehensive financial plan, it's fine. But in this case, a cash flow report, cash flow analysis, cash flow plan is critical for helping people to wrap their mind around not having a check and instead taking income from their portfolio. And we say it all the time. Look, you built a portfolio in order to prepare for this. You're not going to have a monthly check from work. Instead, you're going to take your monthly check from your portfolio. And so that's the hard part or tricky part for people who are retiring to wrap their mind around. And so the big question is how much to take in order to allow that money to generate an income for life. That's something that we as financial advisors do. And so, Pat, what do you think about how much on a percentage basis, or how much should they take? Should they take it monthly, quarterly, annually, et cetera? Like, what's the best sort of plan for distribution?
Okay, I'm not trying to bring the hot take here, but Dwight Eisenhower said plans are useless, but planning is essential. And here's why I like that. You can have all the plans that you want, but at the end of the day, you're not going to know how you spend until you go through that emotional threshold of rediscovering with your partner or to yourself or whoever it is that depends upon you. What does money mean to me? What I tend to find is that people who may be spenders or maybe who have been spenders, they're only really going to change a little. But that little change will typically be, we're not going to spend our money on this because maybe that's frivolous just because we lived this way back in our 40s or 50s. That doesn't mean we're going to live that way in our 60s and 70s. People typically self-correct very quickly. There's the people to the right tail of the median who save so much money and go into a spending drought. Their assets are going to outlive them profoundly. And there's the others who just sort of shrug their shoulders. They're on the left tail of the bell curve who say, hey, you know what? It's just going to work out no matter what. And they don't have the same sense of financial insecurity that maybe others do. Now, with that being said, I do believe that our industry has done a very crafty, almost dishonest thing in saying that financial plans are going to cure your life. Financial plans are going to save you. And I think that a lot of that Kool-Aid has been absolutely chugged because as fiduciaries or whatever somebody may be in this industry, they want to help. I think most of us really, really want to help. I think there's some T-waffles out there who are just there to touch money and line their pockets. But most of the people that we know who survive in this industry, they really want to help people. And the one tool that's been hammered into our heads is give people a financial plan. Now, as you know and I know, again, that's dishonest because are we allowed to name names? Schwab, Fidelity, all of these different places, they know that if you have a financial plan, you're going to keep your money invested for the long term and you're going to do all these things. Subsequently, it enriches that company for doing it. And I think having a financial plan, something in writing, that's something that people are going to grab onto and say, hey, look, I've got this financial plan. And anybody who's had one is going to go, hey, man, the one that we put together 10 years ago is now absolutely useless. As a matter of fact, it's almost a joke when we go back and read through it. That's a hard read. You look back and you look at the assumptions, the capital market assumptions, you look at your spending, you look at inflation and go, man, those are, not only are they worthless, they've hurt you in a lot of cases. Now, with that being said, those plans are useless, but you have to plan. It is essential. Now, getting back to the original question of how do people do it? It's based on the human being. It's based on the you and the me and the mom and the dad and Mr. and Mrs. Main Street on how they feel about money. We all know, and we like sometimes, and I've told you guys this, we'll ask questions of our clients, what does money mean to you? And I'll go back to the one guy who says, hey, we were always broke. We had to hunt for our food and we didn't even like what we were killing. The other guy says, my dad had a restaurant and everybody was stealing from us. So we had to jump out of school and go work in my dad's restaurant. Now there's the others who are going to say, you know what, I've always kind of had money and it's always just kind of worked out. So people are going to spend based on sort of their core values and their core beliefs. And it is very, very difficult to get somebody to break outside of your core beliefs. And all of us have lost, well, I guess we've lost clients because when we come and say, like, here's what the numbers say, they'll sort of look at us and go, no, that's not going to work for me. I've got to go figure out something else. And they might keep going until they find somebody who gives them the answer that they want. But a lot of those times we know the way that the math is going to work. What they want may not be plausible. And that's got to be one of the toughest conversations because you just see somebody speeding towards the cliff and you just go, gosh, someone's going to have the heart-to-heart with them. And as we all know, sometimes when you have that heart-to-heart, we get fired, right? They get up, they look sort of offended and say, hey, I'll get back to you. But sometimes that's what it takes. Long-winded answer, lots of twists and turns there. Thanks.
Thank you for sharing that. Go ahead, Brad.
Well, it's funny because, plans change, right? I think that the biggest part of the plan, because we have at least a basic plan for all of our clients, is so that they can see in black and white what we're saying. Because, right, we got 30 years plus experience each. It's second nature to us. We can look at it and go, okay, this is what it looks like. But it helps us articulate to people getting ready to make this massive change in their financial life. So yes, the plan changes. I have clients, buddy. I have clients I've had for 20 years who every time we meet on an annual basis to update their whole list, the big financial plan. Well, you told me 20 years ago I was going to be at X. And so every now and then we'll be a smidge below. But, and of course, clients always love to tell us when we're behind or under. And so now when we get together, I get to tell her that we're outperforming her 20-year cash flow plan. But the other thing, there's two things that are mission critical here when we're helping clients figure out how much you're going to take. We're not trying to put people on a budget. And I tell people, hey, look, you can't take it with you, right? The last check you write should bounce. You spend it all, take it, and there's some people, of course, they want to leave it to their kids and all this other stuff. But there's two things that are mission critical. Is there a percentage that increases the probability that you're not going to run out of money, number one. And number two is sequence of returns. So Dominic, tell us what sequence of returns is, why, and by the way, that's why it's mission critical to manage your money, not just passively manage your money. And then is there a percentage or what's the formula?
Thank you for the question. I've got to back up a little bit there. And that was rock solid. During the beginning of where we started today, it's about cash flow. And there's many times I've had conversations where it's not about how much you have, it's how much money you have coming in on a regular basis. That's going to give people peace of mind. So if you retire, the hardest thing to adapt to and adjust to is I don't have a regular paycheck coming in every 2 weeks. And if you don't have that consistent income, it makes things more difficult. It's an emotional thing. It's a mental thing where you have to wrap your mind, like you said, around the fact that I have this money, I'm spending it, it's dwindling down. Hopefully I have enough equity exposure to the market will lift that account from whatever I'm taking so it gets replenished. But before we start getting into all those, I like to also make sure that we're looking at all the different buckets. So for example, starting from the left would be the most liquid bucket, which is a reserve bucket, right? So how many years of emergency funds do we have? Because what we don't want to do is we don't want to dip into our long-term portfolio and start paying capital gains and taking out distributions when we don't have to. So for everything that is an emergency, that's going to be 6 months to 2 years of reserves of whatever you need for income purposes. So if your income is 3,000, 4,000, 5,000 a month, multiply that by however many months you feel comfortable for an emergency. And then we start getting into the intermediate term bucket, then the long-term bucket. So those are things that I would focus on first with my clients that are getting ready for retirement versus just saying, okay, here's your plan, because we've been planning for all these years. So it is their job and our job to make sure we did all the correct behaviors to get to where we need to be. This way, we're on the same side of the table. We have a full understanding of what to expect. And again, we might be short here and there, a couple of percentages from what they're doing, but I don't think there is a strict amount of percentage we should be taking from a portfolio. Insurance companies will say 4 or 5%. I think Dave Ramsey a few months ago went on this rant about 60-40 or 70-30 portfolio, where he says, or maybe it was all equity. I don't quite remember, so please don't quote me. But what he did say is, if you're taking out 8 or 9% over a full equity portfolio over the past 20 years, you still come out ahead. I ran some analysis. I have a hard time believing that. And these are just basic mutual funds he's referring to. So if you're taking out 4%, 5%, like most insurance companies are suggesting, that leaves us with inflation that we currently have right now. And we have taxes. So I think a lot of those numbers over the past 40 years have been skewed because inflation is here. I believe it's here to stay longer than people anticipate. So to be honest with you, I really can't give you a straight answer anymore because the long-term treasury rates have went up, inflation has went up, and I think that's something people have to get used to.
One of the problems I think is that the investing public has been sold a bill of goods when it comes to sort of what your expectations could be from equity portfolios. And Don, you just touched on it there. One of the traps that I think the mass producers of this intel does is it gives folks just a poor understanding of how it really works out and how it happens. Brad, you touched on something earlier about static portfolios. Back in the 80s and the 90s, you'd remember these articles that would come out in Forbes and Barron's and stuff like that, and it would say, you take your age, you subtract that from 100, and that should be your bond. And every now and then you'll still hear people say, well, I thought that I was supposed to do this. And I just feel bad for them because it's sort of like saying, hey, listen, how do you fix your carburetor? I'm like, cars don't have carburetors anymore. It's just things change. And man, if I retired today, I would not trust myself to manage my own portfolio, because if I'm gone fishing, right, and I'm not following the capital markets and 9 months go by and I haven't looked at I need someone watching my back. Sometimes I'll hear these guys on the radio and they have these really well thought out, fun shows. And essentially what they're all doing is they're all selling life insurance or annuities, that type of a thing. And they say, hey, call us now. The first 5 people to call will get a free financial MRI. I heard one call it, and that's pretty good. People can, sort of visualize what that means for their money. Yeah, and he says, we'll do this. And I'm a big believer in streams of income. And I'm like, yeah, that makes sense. Mm-hmm. Because if I'm someone down and I have pension, Social Security, maybe rents from a rental income, and I just go, you know what? I just need $5,000 a month pre-tax. Let me call this guy and find out what the math is, and I'll send him a chunk of money so I can get $60,000 a year. If that's say, hey, I'm going to open the toolbox, I just need that tool, and that helps, that's probably great. But what's the 2 things that I said that when we do cash flow analyses for people that 15 and 20 years ago they had that now they don't have? A, it's Social Security that outpaces inflationary costs. That is dead. The other thing is the pensions. Who has a pension anymore? And I know we're here in Silicon Valley and not a ton of people have pensions. And if we were in Detroit, all the auto workers would have pensions. If we were in some other, so it's, if you have those and they're not linked to the same monetary source, right? We have clients that have county pensions or state pensions or city pensions, and those are all different budgets, right? Whereas if some people say, hey, I have this and this and this, and they're all from the same company, but those are all essentially risk assets where if that company has financial trouble, 2/3, a half, or maybe all of those pensions are in jeopardy. They're not guaranteed. So I guess where I'm going with this is that capital markets assumptions of the market's going to give you 7.25 or whatever it is over a long period of time, that's so vague. You just have to keep stretching out that long period of time. As you know, we might make 25% in the market, but we also might lose 25%. And then you have to start doing that weird math of how long does it take me to make back the 25% that I lost? In a lot of ways, you really never ever make that money back.
Investing into a down market or retiring into a down market is sort of the definition of the sequence of returns. If you're taking out and going back to what Dominic, what you said about Dave Ramsey, you can take 8 or 9%, you're going to be fine. I mean, if you're a passive investor and you're just in diversified portfolio of mutual funds and we hit the Great Recession and you lose 47, 57%, and you take out 10% over an 18-month period, you've got significantly less invested. And, the market boomed after that downturn, which is great. I think Dave Ramsey's right. If you invested in middle of 2009 and took out 9% per year, you'd be in great shape. If you invested in 2007 and took out 9 to 10% per year, you'd be underwater. You'd be slammed. So sequence of returns.
Or even if you go back further to the last decade, go back to 1999, right? If you follow that same strategy, I think you'd be very surprised just for those two events, the tech bust and the financial crisis. Following that protocol of taking out 7, 8, 9%, I think you'd be very surprised, irrespective of what the markets have been doing, what that net looks like right now. I ran the numbers. I have a hard time figuring out how somebody would be ahead. Then also, I got some rapid fire here. Pat, it mentioned some things, you had mentioned some things, but active management, I think, is probably the most crucial at this point, right? Having a risk mitigation sleeve in your portfolio. Yeah. Just because at this point, when you're retired, not only is the amount of income that you have coming on a monthly basis from where, but also the risk management piece to help preserve what you do have. Because during a distribution, you have long-term care, right? To help for that. If you're married, you have a spouse, it would be a burden if your spouse can't help you with those daily activities. So long-term care is a big one. And then also, I think a lot of these fund companies have an antiquated approach when they're making an asset allocation wise, because in traditional retirement strategies, they overemphasize how much bonds you should have. Right. And these capital market assumptions in the distribution analysis, they're critical, but I think they're wrong, especially since inflation is what it is today. And if you've over allocated into fixed income bonds over the past couple of years, then they've gotten annihilated. The long-term bonds still haven't even come back to make up what they lost during 2022. So I think a lot of people that are over allocated to fixed income right now are wondering what happened. How come my safe investments are down so much? How long does it take for me to make them back? Or am I going to have to just live off of the dividend for the rest of my life? And if I do have an emergency outside of my emergency funds, how am I going to access capital?
And that we talked about that in a previous conversation also, which is those asset allocation funds failed, right, in 2022. And we're not just picking on funds here. The conservative part of most portfolios was bonds, right? You use bonds to mitigate risk. You use them to level out the volatility of the stocks, and you use them as dry powder while you're looking for opportunities in the stock market. And in 2022, everything dropped. If you've got a passive income strategy, or if you've got a passive investment strategy and you go into retirement into 2022, 2007, 1999, you're going to get clobbered. I think that also underscores a lot of what you talk about, Dominic, all the time, which is you've got to have some alts, some alternative investments in your portfolio. It's got to be a part of the portfolio because they can reduce volatility, mitigate risk, and they are also not correlated with stocks or bonds, right? So bonds are historically and sort of the part of every asset allocation strategy and all the industry's formulas for success. And they fail, and everybody thought that bonds were going to bounce back this year because the Fed said they were going to lower rates. And are they going to lower rates? The January print came out. It was not as good as expected. So it's possible that they're not going to lower rates, which means bonds aren't going to jump back up, which means that part of your portfolio that was supposed to hold up, not only did it lose, in some cases more than stocks, but now it's not going to recover with stocks. So yes, active management is critical, right? And again, find somebody who's an expert at this and don't try to do it on your own. And something Pat said earlier, which is let's cobble together this income. Some's coming from a pension, some's coming from a Social Security. And it's true, none of those things are secure. If everything goes to heck in a handbasket, we can't necessarily rely on those things. But the other thing is people don't think of their stock, their investment portfolio at the same as they do rental property or pension or Social Security. That is a portfolio just like your rental property. If you take a 5% per year clip off, it is there to generate income. And of course, that's our job to figure out, are we going to be in growth? Again, we should be called the bucket cast, right? Because if you've got the right buckets, you have some paying the income, you've got some growing, and then you've got the alts and bonds in some case, mitigating the risk. But it takes active management.
Yeah. And the one thing about alts is a lot of people, what is an alternative? It's a structured product. Those are structured products. There's different types of strategies outside of your traditional portfolio management, and adding those alternative investments, as Brad said, it does minimize volatility. They might not be for everyone, but it's a new place where a lot of traditional investors are starting to get exposure to. And there's research that come out and say 10% of your portfolio should be alternatives, 15% should be alternatives. Not that we're selling alternatives, but if we're looking at mitigating risk, we're looking at different non-traditional ways of getting some type of return that has some sort of stability, meaning it's not as volatile, or they're not meant to be as volatile because they're trying to help mitigate risk, then the alternatives would make sense. Risk parity funds are an example. Long short funds, all these different funds help mitigate risk, but there's a lot that pay a nice dividend that can help you with your monthly cash flow. And even though it's not a massive percentage of your portfolio, again, it's about the amount of money that's coming in on a regular basis versus I'm taking one big chunk out, like I'm taking out my required minimum distribution. And also, we'll get into that later on today. How is that distributed? Is it distributed throughout the year? Is it one big chunk? And then how is the market environment during that time? And I know, Pat, you wanted to get in on that.
Yeah, we should probably demystify what alts are. Not today, but that should probably be something that might be tricky because of compliance. But there's a funny story about how you ask somebody for directions. And you say, hey, how do you get there? And they sit there and they give you these really complicated instructions. And you do this, and then you do that. And then over here, then you do this. And you say, oh, great. Have you ever been there? No, but that's how I've been told, right? So the moral is don't take instructions on how to get to somewhere from somebody who's never been there. So here's where I'm guilty of being the jackass. Who are the absolute experts in spending? 3, 2, 1. Here's the answer. The experts are widows.
What was that?
Widows. You take a gal who's been living on her own. Okay. Harold died when he was 68 because for whatever reason, life expectancy was different. And she's going to live till 94, probably longer. And if you look at somebody who's really expert at knowing where the money goes and how it is spent and how much is left at the end of the month and how much is coming in, they have that down to an absolute science. People say, well, how am I going to spend this? And to Brad's point, this bucket is in cash in case the roof blows off. Over here, these are the 3 or 4 or 5, hopefully different streams of income that we have coming in on a monthly or quarterly or annual basis. Over here, this is for longevity, right? So these are assets that we need growing in case the cost of living goes that much higher. In case you live to be 98 or 102, we have to be able to outpace health inflation, medical inflation, all these different things. So they're the experts. And I'll be honest, I've learned a ton from them, because what's some dude in his 40s or 50s going to really tell somebody in their 70s or 80s about spending, right? So I think intuitively, they've got it down just absolutely to an art form. So that's where I got to kind of call myself out. The best that we could do for them is be able to say, okay, this over here, this is in cash. It's not going to go down. You may lose purchasing power, right? $1,000 today was not $1,000 10 years ago. I'll tell you that. And the other is, here is an inflation adjusted stream of income, maybe from this product or that thing. So it's the best that we can do is building up these different redundant, non-correlated assets that are going to give them cash flow.
I like that. Can I quote you? Different, redundant, non-correlated assets. Wait, what'd you say?
When you said, can I quote you? I thought you were going to say, I'm a jackass. I'm like,
wow.
Yes, absolutely.
Wow. That is, but well said. You're right. That's exactly what people need. I had to give you a little jab there.
Some of the people I think that are at the most risk are the investors, especially during retirement, are the one that had the safe mindset. I won't lose money, right? And those people, I believe, are at the biggest risk because they want to evade all market risks, and they fall prey to the greatest risk of all, which is inflation and purchasing power risk. So you might feel safe, but when you're spending down the cash you have in your money market or your CDs that long-term are not going to keep up with inflation, not going to keep up with the cost of living on your local inflation, because here we have a national inflation, but locally, our local inflation's high. Just look at our PG&E bills have went up 50, 60%. And even if you're not using a lot of electricity, but again, as Pat said, the people that know inflation best are widows because they have to spend that money on a regular basis. But the people that are safe and they don't want to have any type of market risk at all, I think they're the biggest victims to inflation.
One of the things that's important too is tax management. You got a Roth, you've got Social Security, you've got an IRA, you've got a trust account or an individual account. And you need X dollars a month, you need X dollars a year. Of course, we're going to do tax harvesting in your non-retirement accounts, but tax laws change every year. Tax brackets change every year. This is another thing you've got to look at. Passive management here doesn't work. If tax brackets go up, you want to be sure that you don't take so much from your retirement account that it pushes you into a higher tax bracket, and then you're paying a higher marginal interest tax rate on all of the income that comes out above that line, right? So you've got to calculate on an annual basis, where's this money coming from? Is it coming from your Roth? Is it coming from your individual account? Is it coming from your trust? Is it coming from your retirement account? How much should come from your retirement account, et cetera? So tax planning is a mission critical part of the distribution phase. And I know Dominic has a lot to say about that.
So on the RMDs, the biggest problem I've seen over my experience in my career is, when should I take them out? And a lot of people, a common practice is they take them out toward the end of the year. Great. Well, when you take out big chunks of money, I put it into context such as getting a tax bill on your property every 6 months. Nobody likes that. It's a heavy bill. Every 6 months, you got to pay it. Now, when you're taking a required minimum distribution, there's many clients that say, I don't want to take it. What do I do with the proceeds? I don't need the money. Okay, if they don't, then they're giving us a check right back after they pay tax on it to reinvest it in their non-retirement accounts. Okay, what if you take that retirement distribution, which every year it ratchets higher? The IRS wants their money. If you're taking out big chunks at the end of the year, the market goes through a correction, that's going to be a bad look for you. You're not going to feel good about it. You're going to have a conversation with your advisor about it. Or there's the other investor that says, I want to take it out throughout the whole year. And then by the time the market corrects, the impact is less. They have more money invested throughout the year. So if we're in a really good, strong bull market, they're getting that rise. If they take out one big chunk at the end of the year, the market corrects, they're going to have a harder time making up ground. So it really depends on what you feel comfortable. But I've been using RMD throughout the year with a lot of my clients because they feel more comfortable. They get a regular paycheck. They get better cash flow. And again, if the market's going up, they go up. If the market goes down, they don't feel it as much. So that's also something people have to wrap their mind around, is the required minimum distribution, because every year it's going to go higher. And I mentioned this on a podcast prior. Since 2009, the market's gone up. People that have taken out the required minimum distributions, whatever they've been taking out has been replenished by the market because they've had that equity exposure up until 2022. Then it's like, hey, wait a minute. Why is my account down this year? Well, your RMD went up for 5 or 6 straight years. The market's been hot. It's been replenished. And now we went through a bad year where everything went down, even cash, the value of purchasing power. So that's something that they're not accustomed to if they've been taking them out for X amount of time before 2022. And I think that the cash flow throughout the year, from my experience, works best for many people.
One of the things that we do too on our end is just do that exactly. Look, if it looks and feels like 2022, maybe we take more out in the beginning of the year for the whole year, because if it's going to be a challenging year, why take market risk? Pull it out, and if the market drops, you're not going to lose any more on that part. But if we're in a massive bull run, leave as much in there as possible. Maybe switch to a quarterly distribution strategy, maybe as little as possible until December, right? So ride the trend as your friend. Market's going up, make hay while the sun shines, and sort of use that strategy for how much to take and when throughout the year is an important part of the distribution part.
And also working with your CPA, depending on your streams of income that are coming in, as Brad mentioned, if you take out so much where your tax bracket is automatically an alternative minimum tax, You should be talking with your accountant about that and then letting them know, hey, how much more am I going to pay in taxes? What distribution strategy should I be incorporating based on all my other cash flows that are coming in, plus my required minimum distributions? Let's do some tax planning. So you should be talking to your CPA about that as well.
There's a good conversation to be had with people in terms of why your allocation is what it is, because they'll sort of sit across the table and they'll kind of, hold on, shouldn't I be this much in cash and this much in bonds? I read this somewhere, right? And I go, well, here's the thing. Your experience with you is your experience with you, and you don't have experience with anybody else, right? And so it's easy to get myopic. When it comes to money, it's what's fair to me, is what my CPA says. He says, that's how people deal with money. When it comes to money, it's what's fair to me. But when they ask those questions, they'll say, but you have to consider a couple things. Inflation, is it going up? It is now, right? 10 years ago, it was flat. Taxes, are they going up? They were flat for a while, but I think they're going up. Okay. The percentage of what you're going to have to pull out of your IRA, is it static or is it going up? Right. So if your IRA is growing, it's going up. So the cute word is headwinds. We have these 3 headwinds, but let's just be honest. It's taxes, it's inflation. Oh, guess what? There's also this financial advisory cost that we need to cover. There's that too. So you have 4, right? And you put all those together, it's a thing. Literally, it's a thing. There's the fees that are coming out of the mutual funds. If you have these janky old mutual funds that you've owned for years and years and years, and now you're paying about 3 to 4 to 5 to 6 times of what maybe you should. There's that. It's a hidden cost and it creates portfolio drag. There's the cost of the financial advisor. Some people charge, it's kind of all over the board. 1% is kind of what I always sort of feel it should be. Inflation and taxes. So it's, how do you do this? And when you look at that from a, let's get real about this, right? And you say, let's put pen to paper and try to figure out a neighborhood of what it is that we need to, what hurdle do we really need to overcome? And when you do that, you got to have that IRA invested into growth funds. And at some point, if people want to get too conservative with that, it's going to hurt them. And it's hard. And it's kind of like a train crash in slow motion. By the time some of those people realize that it's a problem, guess what? We should have done this 7, 8, 9 years ago. Now I don't want to say it's too late because, I don't know about that exactly. But you're not going to get the recovery or the magic market that I think you may have trained yourself to expect.
And that goes back to having the courage and the discipline to stick with the strategy, endure whatever you need to. This way, in your later years, you can have that and not be so hindered with the 2 emotions that can just make everything a disaster, which would be fear and greed.
Yeah, that's a good point too, because when we have a great bull market goes up, people start to adjust their spending, right? Oh, I'm going to get a bigger house. I'm going to buy all brand new furniture and I'm going to redo the kitchen. Kitchen's $100,000. And then we have a down market. And Dominic said earlier, right, we've got a down market. Your required distributions are going up. Taxes are going up. It's harder to recover from those down markets when you're adjusting your spending. And I'm not saying be cautious or have a budget, but we've got folks who get overly optimistic when the market's going up. And then, when we tell them, hey, look, we're going to hit a rough patch. And they just don't hear it until they see their statements. And then it's like, hey, what is this all about?
Yeah. And if we have a good year where the market's up 20, 30, 40%, and if they have their investment policy and their financial plan in place, and their target is 6, 7, 8% a year, and you have a year where you get 20, 30% returns, you just got 2 or 3 years, 4 years in some cases, returns. Again, don't be hindered by your greed. And then when the market's correcting, don't be hindered by your fear, because then people change strategies because, again, they don't have the courage to stick to a strategy. And then if you ask them, okay, is there a perfect strategy? They say, of course not. And it's like, okay, then why do you keep switching? Stick to a strategy that makes sense for you. And if you can't stick to one, quite frankly, you should not be investing in equity markets. If you think that property only goes one direction and that's up because it's tangible and you can do it, then do whatever you have to do to make yourself feel real good. But at the end of the day, it's having the courage to stick to a strategy. This way, when you get to the distribution phase, you have less of a headache, you have a better plan, and you know where your sources of income are coming from. You're working with your advisors and your CPAs to come out with a tax strategy and a distribution strategy you feel comfortable with. Have your long-term care in place. This way, you're not dipping into your savings or taking out a reverse mortgage, which I've seen a lot of people do, and it's very sad. I don't know why somebody would do that, but I think it's something where when you reach a level of desperation, you have to give up your house. I had that conversation quite a few times over the past few years, and it's disheartening.
I have an associate who was talking to me about, he says, my mom she's 98 years old and she's not slowing down, and she spent all of her assets. And now, we, the kids who are in their 70s, right, we're taking care of her. He says, so we went in to look at a reverse mortgage. And this guy is in an industry where he is extremely familiar with the positives and negatives of that. And right when he said reverse mortgage, I sort of winced. And he just says, hey, there's that. And we looked at the whole thing, but instead my sister says, why don't we do this? The sister said, why don't I take my house, put it into mom's name? When she passes away, my house that will now be in mom's name will get a step up in basis, and I'll take it back. So I said, that's kind of interesting. But what she's on the hook for now is for providing for mom. This is something that I think the people who sell reverse mortgages would probably, obviously they've heard about these things before, like doing this. And I'm not going to get into doing it because I don't have the foggiest idea of what it really entails. But there's a lot of things out there where I've had clients say, well, I've heard about reverse mortgages. Heck, I think Tom Selleck talks about them now, right? But I've taken folks down to talk with this gal who is of great reputation. And I just sit there and I don't say a word because honestly, I don't have anything to add. I just listen and make my client feel comforted to know that someone else is there and advocate on their side. And as soon as we walk out that door, as positive as the client was walking in there, they were inversely as negative walking out of there. Hold on, so I don't get this and I don't get that. And so these commercials, they plant the seed of hope without the punishment of handing over your lifelong asset. For people that do that, if you got to do it, you got to do it, right? Especially here in Silicon Valley where, hey, we bought this house for $25,000.
Now it's worth $4 million.
Well, it's worth a couple $1 million, right? And to anybody outside Silicon Valley who's in a stagnant real estate market, okay, let's just say Buffalo, New York, you could buy a home for $250,000 and 10 years later it's worth $249,000, right? What they must think, these Californians, they're all rich. Like, no, to their sort of understanding of that, maybe we are. But to our understanding of it, it's like, no, it's just a treadmill. I know people hear things and they think, that's not a real problem because why don't you just sell the house and go somewhere else? I'm like, fine, talk to anybody who's ever done that and then say, we're going to start a new life in XYZ, Arizona or such and such Florida, and then realize all of your people, your roots, your family, your life, it's all elsewhere. It's all back from where you just left. And if you have to do it, you have to do it. But it's just such a tough thing.
Yeah, again, I would never bash any kind of investment strategy. That's just not my style, but they have their place, right? But from the conversations I had mentioned I've had, it was a sad event. Any person that I've talked to that has relocated because they're like, okay, I'm going to buy a house cheaper somewhere else. I've had clients that left here in 2021, went to different places in the country, like, you know what, I got to move back. We don't like it here. It's too slow. And a lot of them made that decision during the pandemic. And now they want to come back. And the cost to come back is higher than it was when they left. And because
good luck getting back. You never get
It's
back.
very hard. Yeah, it's very difficult. And
I think all the Texans would love it if the Californians moved up stakes and went back to California.
Yeah, exactly. So it makes it very difficult. But in wrapping things up here, hopefully this series was impactful enough for you to get some information out of. We're working on more series that we'll be coming down with. And we thank you guys for tuning in. And in closing,
Actually, hang on, Don.
gentlemen,
I think that Pat touched on a really important subject here, and it's the sandwich generation. It's people who've got to take care of their kids and their parents, right? So I think the implications of parents overspending or not saving enough to get to this distribution, right? Not accumulating enough, go back to the accumulation podcast and focus on that one, is critical for both the parents' quality of life and the kids' quality of life. Actually, I think it's an important enough topic that we should actually just have a conversation podcast specifically about that.
absolutely. And we will work on that. Anything else in closing, Pat?
No.
All right. Till next time.
Wait, Pat's speechless? I'm done.
I think we've said quite a lot. We say these things, of which I think 98% of it is going to wash over somebody and just kind of go, oh, these guys are full of jibber jabber. But the other side of it is every now and then one person's going to hear one thing that's going to go, gosh, I've been thinking about that, or I've wondered about that, or how do I deal with that? Hope is not a strategy is the one thing that we've heard forever, right? Buy, hold, and hope. It's not a strategy. If there's anybody listening to this find someone local that you can go sit down across the table from, or that you can Zoom with, or that you have a relationship with, and have the conversation, because it's real tough going it alone. That's what I would say.
Absolutely. Thank you for that. Well, in closing, we hope you enjoyed today's segment, and we will see you next week.
Thanks for listening to the Sage Planning Solutions Podcast. Be sure to subscribe so you don't miss the next episode. If you want more information, visit our website at sageplanningsolutions.com.